Well, I would characterize this round of inflation as a little bit of like an inflation storm.
In part 1 of Investigating Inflation, we look at how rising inflation was caused by both supply and demand factors, and further compounded by geopolitical tensions. This episode shifts the focus to the after effects of the measures to temper inflation. Can the average consumer cope with rising costs? And will the rising interest rates and stagnant growth lead to a global recession? A recession usually happens when a nation's economy experiences negative GDP growth for a prolonged period of time. This widespread downturn in economic activity can extend over many years. The 2008 global recession, caused by the global financial crisis, stretched over 18 months. And there are warning signs that a global recession could take place in 2023.
If you look at the recession forecast, UK, for instance, they are expecting to basically go into a fairly prolonged recession from the fourth quarter of this year. Europe, of course, is suffering from this whole energy crisis because of the Russian-Ukraine war. So the whole idea that winter is coming, but the Nord Stream pipeline is actually not running at full capacity, and then if Russia chooses to cut back on supply, then they are also going to be in a hard place.
While the UK and Europe grapple with soaring energy costs, the US is struggling to bring down inflation.
For the US, it's a bit of a different story. Basically, their labour market is still very strong, but because the Fed is so aggressively tightening and hiking rates, that will impact basically business investments and also consumer spending at some stage. And if they overdo it and you get a policy mistake, then of course that could mean that business and consumer confidence is actually hit very hard. Then that's how you end up in a recession. Then China, for instance, the fear is that they have a harder landing than what is expected because of this zero COVID strategy, and effectively, although there is some policy easing, it's not as aggressive as what people will hope for. If you look at their earlier growth forecast of around 5.5%, that seems to have been thrown out the window already effectively.
What about Singapore? Despite core inflation rising to 5.3% in September, manufacturing output fell for the first time since August 2020, but picked up the next month. The outlook remains cautious, and analysts are not ruling out more off-cycle strengthening moves by the MAS. What are the pros and cons of a strong Singdollar?
It's a bit of a double-edged sword, I would say, because a stronger Singdollar means that when you sell your goods to overseas, it's more expensive to overseas buyers. But if you buy a lot of intermediate goods to produce for your business operations, actually it gets cheaper for you as well, right? But I think for households, I think you can see it in the tourism numbers, right? Singaporeans are taking the chance to travel overseas and to buy goods across the causeway, for instance, because of the strong Singdollar.
Many countries have also tightened monetary policy to temper inflation. With the appreciation of the Singdollar, the MAS also reported a negative foreign translation effect, which contributed to an overall loss of 7.4 billion Singapore dollars. Is there a limit to how much tightening can be done?
But there's a limit to this because a stronger Singdollar also makes our exports more expensive and we lose competitiveness against other countries. So we have to be very careful not to overdo things.
While a strong Singdollar keeps prices of imported goods more affordable, how can consumers cope with rising costs?
From a financial standpoint, it's simple. It's either you spend less, you find ways to cut down, or you earn more. It's not that you can control how much your eggs and your groceries cost, but you can control which brand you go for. With grocery bills going up, and depending on what you buy, it can be anywhere from like say 20% to 40%, and switching to house brand can very easily negate that rise. Then the next method is then to increase your income. Either you climb up the career ladder, you demand more wages, make yourself more competitive in the workforce, or you can take up a side hustle, or you can invest.
While the stock markets continue to tumble this year, bonds are proving to be more resilient and increasingly popular as more investors flock to safe havens in times of market volatility.
It's really about redefining what does that milestone or that asset means to you. If you're going to buy a house, are you looking at your house as an asset that you hope to profit from? Or is it just something that you want to live in and build your family and go into your next stage of life?
Housing markets worldwide are struggling, but Singapore property has defied the global downturn and continues to perform strongly. Home prices will rise by as much as 11% this year after a 10.6% increase in 2021. So much so that new cooling measures were imposed in September to temper demand.
Although interest rates are rising, they are still relatively low. And then if you look at the labour situation, everyone is gainfully employed. They are enjoying relatively robust wage gains. And also they have ample liquidity. Household balance sheets are fairly strong. And I think they look at the medium-term demand-supply dynamics and they still think that property is a good investment hedge, especially against inflation. So I think going forward, of course, is really not an issue about what level inflation stays at. I think to me, it's a question more of whether Singapore remains dynamic. Can we get all the investment projects in? If we can, then that will continue to generate well-paying jobs and Singaporeans can actually be gainfully employed and see, wage growth that is hopefully ahead of where inflation is.